This is a FarmDoc Daily webinar. I'm University of Illinois Extension farm broadcaster Todd Gleason. Thank you for joining us this morning. This is the Farm Income and Return Outlook, the first in a series of the Illinois Farm Economics Summits. You may always find these online at farmdocdaily.illinois.edu. Look in the archive section. Of course, we'll have them up in YouTube as well. This morning, Nick Paulson, agricultural economist from the University of Illinois, joins us to talk about farm income and return outlooks for the 2023 or last season and 2024 coming season. Good morning to you, Nick. Thank you for being with us.
Thanks, Todd, as always for the intro and getting us started here this morning. So, as Todd said, I'm going to be covering farm income and return outlook, kind of focusing on 2024 with a bit of a historical perspective when it's helpful. As Todd mentioned, we were on the road last week, giving these presentations in person at 3 locations across the state as part of our in-person Farm Economics Summit, and now following it up with this weekly series of webinars over the next 6 weeks. I will say most of us will probably make little tweaks to what we presented, or maybe even include a few extra additions. I know I have one extra slide in here today that Jim actually suggested, and I thought helped kind of drive home a point that I was making when we were on the road. And we've mixed up the order a little bit too from what you would have seen if you were at our in-person meetings last week. So I think I was third on the agenda during the meetings. Joe Jansen kicked things off with kind of a broader grain market outlook presentation that we heard from Joana Colussi. We mixed things up for the virtual webinar versions of these for a number of reasons, just to accommodate schedules. And I know specifically for Joe, we scheduled his a little bit later rather than first to make sure that he could incorporate information from the February WASDE report that would be released in case that changes anything related to what he'll be talking about. So, as Todd said, you'll be signed up for all 6 of these if you're registered for this one. We look forward and hope you'll join us for more than one of the presentations as we go through this virtual IFES webinar series. So the kind of the flow of the presentation, the sections that I'll be covering today, I'm going to start off, I guess, with the revenue side of things and talk a little bit about corn and soybean prices. And I'm going to really focus on kind of the Illinois picture. As you'll see, same thing on corn and soybean yields. We'll take a look at what the final USDA yield numbers are in terms of a statewide corn and soybean yield average, and talk a little bit about kind of what I think ended up being a positively surprising year in 2023 relative to where we thought we might be in midsummer, given the dry conditions that we experienced this year. Then we'll turn to talking about production costs, and then kind of put those things together to look at returns and farm income for both the 2023 crop year in terms of where we think we stand now, and then probably more importantly, looking ahead here to 2024. And then I'll wrap up with a few points related to looking ahead. As you'll see, it's not the rosiest outlook in terms of returns and farm income, given where prices have gone in the last 6 months or so. And so definitely looking at a much tighter margin environment. And so thinking about, cost-cutting strategies or ways to kind of manage through that relative to the last couple of years, which were excellent return and income years by and large for grain farms. So we'll start off here with corn and soybean prices. So the first chart plots a source that we track. These are daily cash grain bids for corn and soybeans, and we extended this back into kind of the early 2000s, 2002. I wanted to point out a couple of kind of historical things here to sort of set the stage for where we're at and where we might be looking like we're heading in 2024. And so the last couple of years has been kind of another roller coaster ride in terms of corn and soybean prices. Similar to kind of what we experienced over even a longer period in the late 2000s, early 2010s. which we kind of refer to on the farmdoc team as the ethanol build period. Also, when we saw a lot of pretty significant export market development on the soybean side that drove grain prices to what were at the time record highs, but with also a lot of volatility. Then we entered into kind of a lower and more stable price environment from the 2014 to 2019 period. And then again, have been on that kind of roller coaster ride coming out of the pandemic, a big, pretty extended market rally that began around August of 2020. And then another rally, driven partially by some of the uncertainty that was introduced with the Ukraine-Russia conflict in kind of the first quarter of 2022. And then really since then, we've been kind of grinding down, again, with some volatility, some ups and downs, but much lower prices for both corn and soybeans than we've experienced, some of the opportunities we've experienced in terms of pricing in the 2021, 2022, and even the early 2023 crop years. And so want to shift focus here and really hone in on that June 2022 to the current period. That's really kind of the year and a half roughly where we've kind of been consistently working downward for both corn and soybean prices. So here I'm focused on that June 2022 through the end of 2023 period. Opportunities in that June timeframe of 2022, at least days on which you could have sold soybeans in Central Illinois for as much as $18 a bushel. Corn, reached $8 a bushel over a few days during that time frame. We've just been working our way down, trending down fairly gradually, consistently since then. And as of the end of 23, we saw cash grain prices kind of in that mid $4 range, $4.40 specifically, and the mid $12 range, $12.50 for soybeans there at the end of 2023. So pretty significant decline from some of the prices and the marketing opportunities we saw the last few years. And then, that 2023 now is already almost 3 weeks ago. And so even now, if we look at sort of what's been going on with prices, they've kind of continued working their way down. And at least as of Monday of this week, when I checked for some of the new crop bids, so fall bids for 2024, we're even down now into the mid $11 range for soybeans, and even a little bit lower than that mid $4 range for corn, which is still pretty consistent with the numbers that we'll see when we ultimately get to our revised here in January 2024 crop budgets for Illinois. That we'll dive into some of those numbers here as we move on. So again, on the price side, the main message here is prices are still what we would consider historic highs, but much lower, have kind of worked their way down over the last 18 months relative to what we've seen the last 2 to 3 crop years. And that is, as we'll see, going to be probably creating some challenges in a very tight margin environment, given where we've seen production costs head, given those high prices over the last 3 crop years. So those are cash prices. This is the U.S. marketing year average prices. So in the table, we've got the columns in green for the last 5 completed marketing years, 2018 through 2022. And then the column in blue is the current USDA projections for the 2023 marketing year, which we're currently in, and will end in May for wheat and in August for corn and soybeans. And then USDA's longer term outlook that was released in October will be updated in February, but the numbers we have still now from October, looking at a $4.50 price, for corn, $11.30 for soybeans, and $6.80 for wheat. So again, the same stories we saw for the cash grain prices in Illinois. We worked our way up from 2018 to 2020 into 21 and 22, and we're now kind of on a path downward here for the 23 marketing year and looking ahead to the 24 marketing year. And then if we think about at least where USDA thinks we're going based on kind of market fundamentals, they've got us on glide paths to even lower prices for corn, $4.30, significantly lower price on soybeans at $10.50, and $6 on wheat, kind of in that I think kind of 2026 and beyond timeframe. So a little bit longer term there. Obviously, a lot can change, but as we'll see, even the prices we're looking at for 2024 are going to be challenging given where production costs are. And so, and those longer term, even lower prices that USDA has projected out right now will create even bigger challenges if that plays out. On the yield side of things, again, my colleague Joe Jansen, who will be coming up here with his webinar in a couple of weeks, talking about kind of the broader global grain market outlook, and focus more kind of on U.S. yield experience. I know last week he kind of presented very accurately that, you know, from a U.S. perspective, corn and soybean yields in the last maybe 4 to 5 crop years have been mediocre, not terrible, not extremely disappointing, but a bit below trend at the national level. Not exactly where we might expect them to be given the trend patterns that we've seen at the national level. Illinois is a little bit of a different story, though. This is kind of a bright spot relative to national yields. And so as you can see there, we compare the actual yields for, again, this is a statewide average for Illinois. If we look at the last few years there at the far right of the chart, you can see that we've had basically a 4-year run. And then with the exception of 2019, really a much longer run than that of at or above trend yields. So those extra bushels have helped. Always helps to have extra bushels when prices are high. Also helps to have extra bushels when prices are low to offset some of the losses that would occur if we had low prices and more kind of regular trend normal yield levels. 2023, USDA, this is a slight update from what I even presented last week. USDA released their final field crop estimates since those meetings. And they upped their Illinois state corn yield, I think from 203 to 206, if I remember right. So they were projecting just above trend. We'd look at a trend yield for Illinois to be about 202 for 2023. They increased their yield estimate or their yield number to 206, so 4 bushels above that on corn. And again, I mentioned this when we started. I think this was, by and large, a pretty surprising outcome. I think the consensus in terms of the anecdotal evidence, the kind of individual farm reports that we got on yields for this last crop year in 2023 were not great, but definitely better than we thought they would be given where we were sitting kind of in that midsummer period. And just to highlight that, this is one of the bonus slides I mentioned that I added, didn't present last week, didn't include last week, but Jim put this together and I included it today. You know, again, just to kind of put some context around why I think it was a surprise in terms of yields not maybe being, at least on average, worse than what we saw for 2023. You know, the top couple panels I think really exhibit just kind of the extent to which we were experiencing pretty dry conditions during the 2023 growing season. So that 5-year average for topsoil moisture and 5-year average for the percent of acres in the poor and very poor condition ratings, well above, which is not where you want to be, well above that 5-year average kind of throughout the summer there. Particularly in July, and then things sort of started to improve in August and September. Maybe a little bit decline in the outlook as we headed in October, but ultimately, again, ended up with a corn yield that was, you know, above trend, and I think surprisingly better than we thought it might be given the kind of dry conditions that we had in 2023. Soybeans, a very similar story. Again, nationally. Kind of mediocre is probably what you'd say nationally in recent years relative to trend or what we might expect. But in Illinois, again, very similar to corn, we've really, I think, been pretty lucky. You know, there's that one 2019 year there where we were a bushel below trend on soybeans. But other than that, we've had basically a more than 10-year run of consistently above trend soybean yields. 2023, you know, just above what we would probably put as a trend yield for last year. So 63 was USDA's final number in terms of soybean yield per acre. 62 bushels is what we might expect. Again, I think largely better than exceeded expectations based on kind of the growing conditions that we experienced. Now, obviously, there's a lot of variability around these averages. There definitely were areas that were more negatively impacted by the dry weather, other areas that did get maybe some really critical timely rains and had really, really good yield years. But again, by and large, I think the story is we've been really lucky in Illinois. It may speak to good growing conditions, may speak to, solid improvements in genetics and other management practices, probably a combination of all those factors. But it's been a pretty positive story from the yield side of things in recent years here in Illinois. Right now, we're going to shift to the cost side before we put those things together into our return and income outlooks for 2024. I'm going to start kind of at the top level here and include all costs in this first figure we're looking at. So this is a total cost of producing corn. This is information that we get from and based on our partnership, very valuable partnership with the Illinois Farm Business Farm Management Association, Illinois FBFM. And the main point I want to make here, and in all of these cost slides that we'll work through here in the next few minutes, is that costs have been increasing through time. The general trend is for cost increases. Part of that is we're seeing yield increases. We are seeing, higher prices now than we have historically. So, increased revenues are driving that. Inflationary pressures are also driving increased costs of all goods and services. So that definitely plays into this as well. But kind of the other kind of longer term illustration here, looking at these costs going back to 2000, is that costs do tend to increase at a faster rate when we're experiencing higher prices, higher income, higher return periods. And so we can see that played out again in that kind of ethanol build era from the mid to late 2000s through about 2013. We saw our total production costs peak in 2014, at least at the time. That's when they peaked. Then we entered that lower price period from 14 to 19. We saw a slight adjustment, slight decline in production costs. Really more of a plateauing during that lower, more stable price environment. And then you can see the very large adjustment that we saw in those 2022 finalized numbers exceeding well over $1,100 per acre on average total costs here if we include a cash rent number here for land. And our projections for 2023 would be even higher than that at more than $1,200 per acre in central Illinois. Looking ahead to 2024, a slight adjustment down. Talk about kind of where that adjustment down is really coming from. But another kind of theme that I'll try to keep referring back to here as we keep going this morning is history doesn't necessarily predict the future, but it looks like we could be sort of moving into another period, transitioning into another period like we did starting in 2013, 2014. And so, at least that's kind of how I'm thinking about, what the next few years might look like. What if we do move into a more extended multi-year period at these lower prices that we're seeing, what we might expect to see on that production cost side. So where does that slight adjustment downward for 2024 come from? It's mainly from this category, this direct cost category. We wrote a series of articles on production costs on FarmDoc Daily this fall, kind of touched on these categories that I'll touch on today, so you can get more information from that article series. But direct costs would include the main, largely the inputs that farmers use. So the biggest component here of direct costs would be your fertilizers, your seed, and your pesticides. So again, as with total costs, this component of total costs tends to follow returns. So generally trends upward over time, goes up more quickly in high return periods, slight declines and plateaus during lower return periods. And so we see the big adjustment in 2022, another bump up in 2023, reflecting the high returns and incomes we've had the last few years, and projecting the most sizable decline in terms of subcategories here in this direct cost category And so that move from around $580 per acre down to $520 is pretty much entirely being driven by a cost reduction that we're projecting here for those fertilizers that go into that direct cost category. And so again, another topic that we've wrote a number of articles on farmdoc in the last year or last 2 years even, looking at that big increase in prices that we saw. So from a pretty stable price environment from 2020, and even if we extended this back even further back than that, to rising prices starting in 2021, peaking in 2022, some of that associated with the Ukraine-Russia conflict, and then kind of since that mid-2022 period, just like with our corn and soybean price series that we looked at, kind of trending or working our way down, and where we were at least at the end of 2023 and into the first couple weeks here of 2024, kind of back to those 2021 price levels that we would have been looking at for, purchasing fertilizers for that 2022 crop. So, still historically high, but lower than probably what resulted in some of the highest or the highest fertilizer costs that we've seen for both the 2022 and 2023 crop years. A little bit of relief here in 2024. We can see that again if we kind of take that direct cost chart that does include some other things like storage, drying, and insurance, but mainly is comprised of these three input categories. If we look at those inputs even on their own, we can see kind of the general trends in seed and pesticides is up. Fertilizer is a cost component that we see, again, that's going to follow returns, but can be more variable just because it is such a global commodity and subject to kind of factors that global commodity markets are subject to in terms of the volatility that we see. And we see that big spike for both 2022 and 2023, and that adjustment down that we're projecting for 2024, driving that slightly lower production costs for 2024 that we talked about. The other point that I want to make on this slide is kind of focused on that pesticide cost series. That's one where it is a smaller component of these direct costs than fertilizers are in terms of dollars per acre, but it's one where we've seen some of the largest relative or percentage increases in the last few crop years. In talking to some crop scientists, agronomists about this, I think there's a number of factors here. I think from the economic standpoint, the high commodity prices that we've seen, high corn prices, high soybean prices, have sort of made it easier to justify pulling the trigger on some additional applications, whether that's herbicides or, in the case of corn, I think we've seen a lot more fungicide applications in the last few years. There's also some herbicide resistance that's part of this story that I think is requiring producers to use some more costly products, additional applications, higher application rates that have been incorporated into that. It's a cost category that we are projecting a continued increase for 2024, just kind of based on those trends, but maybe an opportunity. I think if producers really kind of take a harder look at the economics of some of those applications, particularly on fungicides. Again, I think really easy the last couple of years to do preemptive applications of those things to protect those yields at those high price levels. I think we're in a different kind of decision-making situation here with the lower prices we're looking at and the tighter margins. Just something to think about, to take a harder look at once we get into the growing season for 2024. The next category is power costs. So this is largely going to be costs associated with farm operations machinery. Again, these tend to trend up as well. Also tend to see kind of more movement or a pattern here that follows the income and return levels that we see. Makes a lot of sense. Higher incomes, got to want to reinvest in the operation when you've got the resources to do so. That generates some demand, probably increases prices for equipment related expenses. And so we saw kind of jumps in those expenses in kind of that early 2010s period, following the couple of years of higher incomes in the late 2000s. We've seen that creep up in 2022 as well. and are projecting higher power costs in 2023 and 2024. I'm sure there will be some adjustments made on farm operations here as well. We'll probably more than likely, if these price levels and income projections play out that we're getting to here in a moment, we'll probably see some lower investment activity in machinery in 2024 and beyond. But still some higher costs here based on some of the other categories that go into that power cost area. The one bright spot on power, talked about fertilizers for direct costs. Probably the one bright spot here where we see some relief in the power cost category. Again, at least relative to the last couple of years, is we have seen diesel prices again kind of work their way down from that late summer to 2022 period. Went above the $5 mark in June of 2022, late June of 2022 there, and have kind of worked our way down back to that $3 per gallon neighborhood, which, just like fertilizers, is sort of where we were at in late 2021, early 2022. So still, historically high diesel prices if you take a longer look back, but some relief relative to the last couple of crop years where we had the highest fuel costs that we've seen in history. And then the final non-land cost category that I wanted to touch on here is the overhead cost category, and specifically want to talk about interest and labor expenses, which are components of that overhead category. This is a category that, we look historically here. We did see some declines in overhead costs in the early 2000s, but really since 2004, the trend has been pretty consistently up. And so while we experienced continually declining interest rates over a big chunk of that period, more dollars were becoming involved. Higher operating lines were required. More dollars were required in terms of borrowing to provide the capital requirements for farming. So even with lower interest charges, interest expenses continue to creep up with nominal debt levels. We've also seen labor costs tend to just increase over time, as well as many of the other overhead cost categories are kind of more subject to follow just kind of general increases over time due to kind of general inflation. Bigger increases in 2022, projected for 2023, and then continuing into 2024. Again, I mentioned labor and interest as the two things I wanted to comment on here. Labor has been something that has always been a challenge in production agriculture, but hearing more and more about some of the challenges in terms of identifying reliable and qualified labor for farm operations in the last few years, that has increased overhead costs. And then we've also been in a unique, at least in the last 20 years, unique to be in kind of a rising interest rate environment as the Fed has tried to increase interest rates to battle some of the inflation we've experienced coming out of the COVID pandemic. There is some optimism looking into 2024 here, maybe the latter half of the year now, where we might see some rate reductions again on the part of the Fed, which could reduce interest rates and interest expenses for farm operations and other businesses, as well as individuals. But that's not going to come on a timeline that'll benefit or impact interest costs for 2024. It'd be more looking at a 2025 and beyond period. So we've got an increase in here projected for 2024 for the overhead category. All right. In the handouts, I've got kind of tailor-made slides here for the next three for each of the regions that we include in our budgets and our return projections for Illinois. And so the first set is for Northern Illinois. I presented those when we were in DeKalb last week. I've also got a set for Southern Illinois that I presented in Mount Vernon last week. And then when we were in Peoria, I presented numbers on Central Illinois. And since I'm in Champaign, just in the interest of time, and the fact that the patterns that emerge from those figures are the same regardless of region. The numbers might differ slightly, but the patterns are the same. I'm going to focus on the central Illinois set here, but again, all three regions are included in the handouts if you want to review those numbers. The messaging here is consistent across all three. So here are our January update, or here is our January update to our 2024 crop budgets that were originally released in August. Worked with Gary Schnittke on this, and we released these in a FarmDoc Daily article, I believe now a week ago or 2 weeks ago. And I think last Tuesday, we released those the day we did our first in-person IFES meeting in Mount Vernon. So if you want more information about this, that's detailed in an article from last Tuesday. The big picture message here, again, which I've already discussed as we work through this presentation, is that 2023 and into 2024, we're in a significantly lower price environment, and the outlook is for that to continue potentially moving down than we were definitely in 2022 and even 2021. And so we have the 2022 finalized numbers provided here, just to, again, provide us some sort of perspective on this, that we've come out of just a fantastic record return and farm income year in 2022. 2023 and 2024, given the lack of evidence and any real reason to think we're going to see any significant downward adjustments in those production costs, at least in a 1 year period here, given where those production costs have reached, that downward adjustment in those prices is resulting in some negative, pretty sizable negative return projections when we budget in a land cost that would be what we would think a typical cash rent would be here in central Illinois. Again, same story, different values maybe for northern and southern Illinois, but kind of the same story. Cash rented land at average cash rent levels. We've got negative returns here built in, projected here for corn and soybeans for both 2023 as we wrap that year up. Again, we're still in the marketing year, still marketing that crop. And then looking ahead to the 2024 crop year, which we'll be rolling into here in the next couple months with planting season. So like I said, when we started, not the rosiest picture, rosiest outlook looking into 2024. But again, I think having to have that perspective of the last 2 to 3 years being excellent income years, I think the positive way to look at this is we are pretty well positioned from a financial standpoint to potentially weather a storm here and give those production costs a couple of years to adjust, which historically that's what it takes to see any real sizable downward adjustments in those non-land or land costs. All right, this is just more of a visual view of this and a longer term historical view of this. So the blue bars here are those operator and land returns. That's crop revenues minus non-land costs. And then I've plotted that cash rent value there. And so when you see that gap where that cash rent level is above those operator and land returns, that's the situation we're in, where we'd be projecting negative net farmer returns on cash rented farmland. Obviously, the picture is a little bit better for owned land, particularly owned land that is paid for. Share rented or variable cash leased land, we'd be looking at smaller, probably closer to break even, or definitely smaller losses than we would be looking at some of those fixed cash rent situations, which we're kind of illustrating here. Again, looking at this figure, I think kind of, again, history doesn't predict exactly what's going to happen in the future, but we're just seeing a lot of potential parallels here between what occurred and kind of what was experienced coming out of that 2013 kind of ethanol boom era, ethanol build era, potentially, setting ourselves up to, enter the same sort of situation moving forward here in 2024 and beyond. This is always something that we track as well, kind of comparing corn and soybean returns. So looking back in years where we've got those orange bars that extend up, those are years when corn returns per acre outperform soybean returns. Those green lines or those green bars that extend down, those are years where soybeans had the advantage in terms of return. We are projecting advantage for soybeans in 2023 and then looking ahead to 2024. Again, pretty consistent with my colleague Joe Jansen's messaging. When we look at relative prices, there's maybe a moderate signal on the relative corn-soybean price ratio for more soybean acres relative to corn, given where we're at. That's a situation that constantly changes. This could change, but looking ahead here, an advantage here for soybeans for both 2023 and looking ahead to 2024. Sort of the tough way to interpret this, though, is you're basically looking at losing less money by planting soybeans than what you might lose for corn, particularly on those cash rented acres. If your cash rents are kind of on that average to higher than average level for your region and your cost structure. All right, here's those Southern Illinois slides. I'm just gonna, again, skip through those. They're in the handouts for you. And this brings us to kind of the net farm income picture. So again, perspective is key. I know I've got that bullet point coming up on one of my final slides here towards the end. But 2021, 2022 were just record and excellent income years. So again, this is an average across farms in that Illinois Farm Business Farm Management Association. That's what these numbers are based on. The projections are, you can blame me on the projections, and these things could change. But basically, given the return outlook that we just saw in those crop budgets, both for 2023 and 2024, I don't personally see a lot of optimism that will be anywhere above, that $100,000 mark in terms of average net farm income. Obviously, that's an average. That's a projection. I could be wrong. Individual farms will be in their own individual situations depending on how they've marketed their crop. But just based on those average return projections, basically we'd be back to returning to some of the average net farm income levels that we experienced from 14 to 19 when we had that price downturn again after that ethanol build and export market supported period of higher incomes in the late 2000s, early 2010s. All right, so looking ahead, the first thing I want to do is, again, a couple purposes for this. One, I really want to highlight some of the soothsaying, the excellent work that some of my colleagues did now 15 years ago. And so Scott Irwin and Daryl Good, 15 years ago, had written some FarmDoc Daily articles that basically made the argument and made the projection that we were entering into a new era of commodity prices. Ethanol export market development were, the big factors, again, leading to this. So changes in market fundamentals. And this fall, Scott successfully pulled Daryl out of retirement, and they did a follow-up just to see how well they did 15 years ago in kind of projecting out where they thought prices were going to be. And so what they had done back in 2008, 2009 was that for corn, soybeans, and wheat, and we'll take a look at each here. This is the illustration for corn. They projected kind of what the new longer-term average would be. And they projected a low and a high, or a range that they thought corn prices would probably trade in moving forward in that new era. And so we're looking at era number 3 here. So basically late 2006, early 2007 to whenever, but arguably still definitely in that new era period. And they expected that corn would average in kind of that mid $4 range. 461 was the specific number they put on it, and probably trade within a range of $3 to that high $6 range. Well, we have the pricing experience now from that period where they set those numbers back in 2008. And I would say that Scott and Daryl pretty much nailed it. So we've actually averaged $4.59 on corn since the beginning of 2007, and you can see that we exceeded their high a bit, a few times, but generally traded within that $3 to $7 range, just like they had kind of forecasted 15 years ago. Soybeans, it's a very similar story, obviously with different price levels, but they projected an $11 average, or just over an $11 average, with a trading range of the high 7s to the low 18s. Actual average that we've had since 2007 is 11.25. So again, I think a pretty good forecast error there relative to what they predicted 15 years ago. And then for wheat, again, a very similar story. A range of 330 to 1015 with an average of 580 was what they projected. We've actually averaged 571. You can see the trading range there has pretty much been spot on for where we've seen wheat prices in terms of the range over the last 15 years. All right. So again, I wanted to highlight the kind of the work there that Scott and Daryl did, and just how right they ended up being. But the other reason to kind of mention that is, thinking longer term, 21, 22, and some of the early 23 pricing opportunities that we had, I don't think should be viewed as the norm. And so thinking about the price levels that we're looking at moving forward, that low $4 range for corn, mid $11 range, maybe even getting into the $10 range longer term for soybeans, not at all out of the realm of possibility in terms of what market fundamentals suggests, at least in terms of the work of two of the people I consider some of the leading market experts in Scott and Daryl. So again, I think we need to think about we're kind of back to the norm now. In the last couple of years were great, but I think we got to start thinking about making the management decisions needed to be able to successfully operate in the price environment that we're currently in, and not thinking that $6 corn and $13 beans or even higher is the norm moving forward. All right, so thinking about those things for 2024. So I'm an economist on campus that doesn't farm, and I look at data and I talk to farmers. So some of these suggestions may induce some eye rolls. I know they do in in-person audiences when we talk about these things. But I think it's still useful to talk through some of these things. Not all of them are necessarily easy to implement, but I think still some important things to think about and try to implement moving forward, given where we're seeing prices at. So again, a quick review of what we talked about on the direct or input cost side of things. 2024, some relief on fertilizers. That could continue. Prices are still historically high. We could still see some lower fertilizer prices moving forward, but some relief there. And then the other point I made on that direct cost category was looking at those pesticides. Again, just reiterate the fact that the economics of some of those pesticide applications here in 2024, I think, are deserve a harder look than maybe the last couple of years, just because of the margin environment that we're going to be operating in. On the power cost side of things, we do see capital purchases, machinery purchases adjust quickly to changes in returns and income. However, from an ongoing cost perspective, that's a ship that's really hard to turn around in a single year. But really important to make sure that your machinery complement is kind of appropriately sized for your operation. And other advice that we hear from lenders and farm managers is to make sure your kind of financing is as lined up to the extent possible that you can with sort of how you're expensing that for tax purposes. I know a lot of opportunities exist to do accelerated depreciation on things. There's sort of other longer term things to factor in other than just kind of short term tax avoidance, especially as we go into a lower return period. And then on those power costs, I think the one thing, again, kind of similar to the pesticide comment, it's those harvest and tillage operations that we see the biggest cost coming in annually. And so any efficiencies that can be identified there I think are areas where you can find $5 or even $10 an acre that can really help out in the return environment that we look like we're heading into with the price levels that we have. Overhead, I don't have a ton of positive news here, especially for 2024. And I think labor is going to be a challenge that's basically here to stay. It's not an ag specific thing. I think we're going to be facing increased labor costs and labor market challenges on an ongoing basis here in the U.S. Moving forward. This is a bigger kind of national problem that we need some solutions for here than can probably be managed or easily managed at the individual business or individual farm level. Interest rates, as I said, some relief potentially on the horizon, but probably nothing that'll impact costs in any significant way from an interest expense perspective until 2025. Land, this is the one that we always say when we get into lower prices, lower returns, land costs have to come down. They have to adjust. And when you look historically, they ultimately tend to adjust very little. And it's difficult to do on the ground, work with a landowner, given they're dealing with higher property taxes continually across time. And coming off high income years, it's a difficult conversation to have. We realize that to try to get land costs down kind of on a year-to-year basis when the income outlook turns more sour. But communication is key on this. And the other point I'd make is another thing that we've written a lot about in the last couple of years, in particular on farmdoc, is these variable cash leases that continue to increase in use and popularity. They are more difficult to set up on the front end, but they are sorts of things that address some of the negative aspects of share rent agreements and the management responsibilities that need to be shared with those. The variable cash lease gets around some of those issues, but then also introduces some of the risk sharing benefits from the farmer perspective, as well as the landowner's perspective, because they will end up doing better from a rent received standpoint in some of those good years as well. And once you can get one of those set up and you're happy with it, you can really get into a set it and forget it kind of mode where your rent is going to adjust automatically to the return conditions that you're in. As we wrap up here, a few comments on risk management. We're planning on doing at least a couple of webinars related to risk management decisions here in February and early March. So we'll talk more in detail about risk management for the 2024 crop year and those. But crop insurance, we're probably almost certainly looking at probably lower crop insurance prices for 2024, unless markets take a considerable turn upward here in February, meaning that we're going to be insuring lower revenues than a lower dollar amount at any coverage level compared with the last couple of years. So that, and crop insurance is an area where we never really recommend that as an area for cost cutting. So if anything, crop insurance is an area you might want to even consider investing more in, maybe taking a look at higher coverage on your individual plans that you use, or even some of the supplemental area options that are out there with the supplemental coverage option, enhanced coverage option, SCO and ECO options. Commodity programs, again, we'll talk more about these in webinars focused on those topics. The ARC PLC decision in the last couple of years has been, honestly, kind of irrelevant given where prices were. The likelihood of payments from either program was nearly zero, unless you had some kind of localized yield losses that affected county yields enough to trigger an ARC County payment. 2024 is looking like those likelihoods are still low, but higher than they have been, and probably a little bit of more of a decision here, something you want to put some more time and thought into in terms of that ARC and PLC decision, and also how that might interact with your crop insurance choices. And then finally, again, those red numbers that we saw there look kind of scary. You get into situations where you're looking at $100 per acre and potential losses. Nothing, it would take some additional legislative or administrative action here. There's no ad hoc support or natural disaster assistance support authorized for 2024 or 2023 or 2024 yet. But definitely a possibility, not something I would bank on, so to speak, to use a pun. but a higher potential for those given kind of that return outlook that we looked at, the potential for some of those programs to step in. All right, last slide. So again, perspective is key. Coming off some fantastic income years, I think we're well positioned financially on the vast majority of farm operations throughout Illinois and the Corn Belt to manage through some tougher years here. And then I want to wrap up here with just again, want to credit FBFM and some of the work their staff have done, as well as some of the work we've done on the farmdoc team, kind of identifying some of the characteristics of some of the farms that we've identified in FBFM that have kind of consistently outperformed their peers over time. That doesn't necessarily mean they're always making a ton of money every year. It just means that whatever conditions they're faced with, they tend to manage better through it and earn higher returns than some of their peers that are included in their peer benchmarks. This advice isn't super sexy. It can induce eye rolls from farmers. I think bankers like to hear it. But a couple of the points that we've identified that are associated with kind of those consistent top performers is they really know the financial side of their business. They have financial statements put together. They know their cost of production. They focus on cost control. On the capital purchase side, their machinery complements are very much sized correctly to the size of their operation. And then marketing is one of those things that does not show up as one of those areas that differentiates consistent top performing farm operations from others. Hitting market highs is not a long run success strategy. It's very difficult, if not impossible to do. And so really the best, I think any individual farmer can hope for. Marketing is not something you should ignore, but the best anyone can hope for is to just be able to take advantage of profitable sales opportunities when they come up. And that really requires knowing your cost structure and knowing your cost of production and what your break even is, so you can identify those profitable opportunities. All right. Jim is reminding me that we should have started Q&A multiple minutes ago. So I was a bit long-winded here this morning. But with that, I'm going to wrap it up and remind everybody about our upcoming IFES webinars here, part of our virtual IFES series. So next Thursday, January 25th, we'll have a macro and farm financial update that Brad Zwilling from FBFM and Gerald Mashange, new faculty member, part of the farmdoc team here in the Ag and Consumer Economics Department, work together on. February 1st, Joana Colussi will give us a update on South America, crop production in an El Niño year relative to the La Niña years that we came out of. February 8th, at a different start time to accommodate the February 8th WASDE release. So they want to incorporate that information into the webinar that day. So it'll be a real-time look at any market developments from that WASDE report. Joe Jansen will lead up that grain market outlook session. February 15th, we've got the farm policy session with our favorite son, Jonathan Koppas. And on February 22nd, Scott Irwin will wrap up the series with his presentation that garnered a lot of interest last week at the in-person meetings, focused on the renewable diesel boom, what the future of that looks like, and how it might impact the commodity markets. The other thing we want to make everyone aware of is that we are starting, folks here in the college are working with us to start a farm safety webinar series. So Cultivating Caution, a monthly guide to farm safety and health. That will be starting next week, Jim, is that right? Yep, next week. And we'll be doing a monthly webinar on that, or team members will be doing a monthly webinar on that. That will be held on Tuesdays, or at least the first one next week is on a Tuesday. And that will be going through at least November is what they've got scheduled out so far this year. So please do register for that. Farm safety is an important topic. I want to thank our sponsors, TIA, Center for Farmland Research, Compure Financial, Illinois Corn Growers Association, Corteva AgriScience, FS Growmark, Farm Credit Illinois, and the Illinois Soybean Association. We highly value their partnerships, both on the financial side and then also the network side, the professional network side. Keeps those of us there on campus, here on campus, connected to what's going on the ground with our stakeholders. Thank you to them. Thank you also to our educational partners. Obviously, the FarmDoc team is are faculty members in the Department of Ag and Consumer Economics, which is a department in the College of Agricultural, Consumer and Environmental Sciences, College of ACES at the University of Illinois, part of University of Illinois Extension, and also the Illinois Farm Business Farm Management Association. Thank you to all of those departments, groups, organizations as well. And thank you for joining us today. We will now move on to take any questions. And I do not have any questions on the big screen, Jim. Typically, when I have no questions at the end of a class on campus, it means that the audience, I explain things so well that there are just no questions. Or I was so poor that they don't even know where to begin. All right. Well, if there are no questions, we don't need to answer any questions. Give people a few more minutes to think and type in. I can ad lib here a little bit. I know some of the questions that we got last week related specifically to my session, my presentation here on the farm income and return outlook. A lot of questions did kind of direct back to some of those risk management items that I said we will do some specific webinars on here coming up in February and early March as we get into the crop insurance price discovery period, as well as the commodity program choice deadline and the crop insurance deadline of March 15th. Again, I think there is going to be a harder look taken at that ARC PLC decision this year relative to the last couple of years. Still relatively low likelihoods of payments, even with the lower prices that we have. But we have seen those effective reference prices come up for 2024 based on the high prices that we've had, at least for corn and soybeans, over the 5 marketing years that work into that calculation. We actually highlighted that this week in this Tuesday's article, which you would have gotten an email about on Wednesday morning if you're a FarmDoc Daily subscriber. But an article authored by myself, Gary Schnittke, Carl Zuloff, and Ryan Batts from the FarmDoc team, where we released an updated version of our Excel comparison tool for the ARC and PLC programs that you can take a look at tailored situations, and also discussed kind of the broad view of the look at 2024 for how those programs are shaping up. So again, we will cover a lot of that in more detail with some articles and webinars here in February and March. But some questions on those did pop up last week, so I did want to tell our listeners here on this webinar that we did put an article out on that. So there's some resources that we've already started releasing on that ARC PLC decision. We'll be talking more about that and crop insurance moving forward. Again, I want to thank everybody for joining us. Please do join for the upcoming IFES webinars as part of this series, the Cultivating Caution Farm Safety series that will launch next Tuesday. Thank you and have a good day.